Hey everybody, it's Will at VIP Mortgage, and it's time for your local lender update. Rates are pretty close to unchanged again this week. You can see the chart just over my shoulder here. What I want you to notice is we're seeing a little bit of a dip and then back up, and a little bit of a dip and back up. We keep trading in what's a pretty small trading range, and we keep bumping. This chart is inverse, so the higher that chart goes, the lower rates go, and we keep bumping into that spot where rates are as good as they've been in quite some time. And we're trying to find some kind of reason to help us understand where the market's going to go from here. That's a little tricky to do, but the indicators are, especially based on last week's inflation report, that we should get past that point of resistance, which allows rates to get a little bit better. The inflation report was kind of mixed. It met expectations as far as what the rate of inflation was, but when we dig a little deeper, we found some interesting opposing data in the report. Wage growth was higher than expected. That's generally an inflationary indicator. However, consumer spending was down, and the vast majority of the American economy is consumer spending. So with the spending down, that actually helped the report overall have a positive effect on the market. We're also seeing an inflow of money from stocks, which are having a rough time, into bonds, which is the market where rates are pegged to. And that flow of money from stocks to bonds actually improves bond pricing and therefore improves rates. So we're seeing this shift around, and one of the interesting things, in a recent interview, Scott Bessent, the head of the Treasury, was asked about the balance sheet of the Treasury. Since COVID, that balance sheet has been about $600 billion, and they're trying to get it down to about $300 billion. What does that mean? It means that the government is carrying less debt overall, which means there's less debt being put onto the bond market, which overall helps pricing. That was a very keen question. You won't see it on the news because it was a private interview, and that interviewer put his finger on something, and Scott Bessent's response was, "I'm not in a position to comment about that, but you're very insightful." And when asked about his pricing target, again, the interviewer had pegged the correct pricing within 0.1%. So what that tells me is the government is actively trying to make rates go down. The question is, will it work? This week, the big news is going to be tariffs. On the 2nd of April, the new reciprocal tariff regime kicks in. This is causing a lot of uncertainty in the markets because it's never been done before. Essentially, Japan charges a 700% tariff on any rice that they import. In the stated policy, that means we would charge them 700% on certain imports into the United States to create an equal playing field. I think we're going to see some bumpiness because of that. I think there's going to be some changes and adjustments in lifetime. But overall, that uncertainty and especially the flow of money out of less dependable assets into the bond market, I think that general direction should support rates staying at least where they are and possibly getting a little bit better in the next month, 2 months. May take as long as the summer, but I think it's closer now than it has been in a while. So keep your eye on that, and if there's anything we can do for you, if we can get you a rate quote for your situation, give us a call, 719-232-7553.